Welcome, everyone. This is the second seminar of the inaugural Digital Finance Seminar Series. For those who weren't here at the first seminar, our goal is to really bring together the top researchers in industry and in academia on issues related to digital finance broadly, things like blockchain and decentralized finance and so on. So this is our second seminar. I do want to acknowledge my co-organizer in the front row, Agostino Caponi. It's a joint effort between the business school and the engineering school. I also want to acknowledge Tim Roughgarden in the back, who has been helpful with us in organizing this series. Aside from today's lecture, which I'm very excited about, we have two more talks coming up this term. Also, I want to call out that on December 1st, along with the Ethereum Foundation, we are jointly organizing a conference on crypto economics. This will broadly relate to issues related to economics and incentives and layer one protocols. So again, all of these are oriented around providing a nice forum so that people in industry who have sort of the real kind of state-of-the-art knowledge of what's going on and what the practical challenges are to interact with us at academics. And to that end, I'm really happy to introduce our speakers today, Alex and Quintus from FlashBots. They're going to talk today about MEV, which is maximal extracted value or minor extracted value or something along those lines. I'm sure they will spell it out in great detail. All I want to say for the moment is this is really one of the most important topics in terms of incentives and blockchain today. It really dominates a lot of the conversation that I hear. You can see it's also the topic of our third talk. I think it will also be something that's very central to the workshop. So this is really one of the most important topics today, and I think it's impossible not to acknowledge FlashBots as really having a central role in both the discussion and in really being out there and implementing things. So I'm very excited to hear what Alex and Quintus have to tell us today.
Thank you. Thank you for having us. Thank you for inviting us, and thank you for joining as well. Quintus and I are both researchers at FlashBots and working hard on MEV, which stands for currently maximal extractable value, used to stand for minor extractable value, not extracted, as might have been said in the last few minutes. We want this talk to be interactive and open, so while we do have slides and an outline, I think we're very happy for it to be more of a conversation and for you all to ask questions. So please feel free to ask questions whenever, and also it's okay if we don't go through the slides and if we go a different direction. So I'll start with that. The other thing is that we've kind of catered this talk to a certain level that we expected the audience to have after asking, but there's always uncertainty about who's going to show up, right? So if the level of sophistication is different than the one we anticipated, we can also switch gears a little bit, so we'll do that. Clicker. All right. You'll excuse us for the poor design of the slides. The talk structure, very roughly, is we'll introduce what MEV is. We'll try to explain it in ways for people that don't understand. And then we'll introduce a selection of open problems that are, I would say, at the cutting edge of what people are thinking about related to MEV. Our goal really is to maybe link some of these problems back to concepts you understand, as well as just give you a more solid grasp of what MEV is. Right. Yeah, before we start. Oh, the emojis are different. Yeah, before we start, how many people are familiar with Ethereum? Raise your hand. Okay. How many people know what the Ethereum mempool is? Okay. 40%, 35%? How many people have heard of decentralized finance or are familiar with it as well? More than MEV, okay? And, well, no, actually, the mempool. And how many people are familiar with MEV already? 20%, I guess? 30%, okay. All right. What does that mean for our calibration, Quintus?
I think just run with it.
Oh, okay. All right, for the people that aren't familiar with Ethereum or with the mempool, which was a majority, we'll honor the fact that you were the majority, and we'll talk briefly about, we'll give a useful abstraction to think of MEV or where the problem originated. We'll then move to use that abstraction in ways to explain these open problems. Sounds good? All right. There's time here as well. I'll make sure to stay on time. All right. I'll use a whiteboard. Can I use a whiteboard?
No, stop that.
Great. All right. So I want to give an abstraction for Ethereum and its mempool. And so big disclaimer, abstraction. It's not what happens exactly in reality, but it's still useful. So a way you can think of Ethereum is a network of nodes, right? All right. Each of these are nodes, and they talk to one another. And so when I want to interact with Ethereum, I want to send an action or a message, what my intent is, through a node, and I communicate that with the other nodes. Again, simplification, no one is outraged. So I want to send a transaction, say this is my node, and then I want to communicate that transaction to others in the network. I'm going to communicate that through some kind of like gossip mechanism, where I'm going to talk to, for example, the closest peers to me. That's one way you can do this. And then it's communicated throughout the network. Now, in a lot of blockchains, there's well, on Ethereum in particular, a leader is chosen to take a bunch of transactions and create a block with these transactions inside it. And this leader is predetermined, and you know in advance, and they have a fixed capacity for how many transactions they can include or the space that these transactions can take. So far, submit my transaction, a bunch of other nodes get it. There is a predetermined leader or predetermined node in the network that is allowed to take these transactions and create a block out of it. That block is then sent in the same communication layer to the other nodes in the network. So far, so good? All right, cool. So I think I can move on potentially. All right, this is a very simple mental model, but we go with this. So let's do like a very simple thought experiment. Suppose there exists a price imbalance between two exchanges that are built on top of Ethereum. You'll notice I barely talked about what is built on top of Ethereum. There's more people that know about DeFi, so I'll assume you're good with this. So assume a price imbalance exists between two exchanges because of an action that is submitted at block n-1. Block n-1 is constructed and then is shared with the other nodes in this gossip manner. Now, other individuals can see this block, can react to it and say, hey, there's a price imbalance here. This is an arbitrage opportunity where I can buy an asset somewhere at a low price, sell it somewhere else at a high price. You want to benefit from this price imbalance. However, this opportunity is finite, and it's capacity constrained, right? So the more you buy low, the more you're going to raise the price at this one liquidity venue. The more you sell at that other liquidity venue, the more you're going to push the price down, right? And so in reality, it's often the case that only a single actor can seize this opportunity. Still, so far so good? All right. So how is the winner decided in the system? Given that ultimately, multiple people will submit their desire in block N to have their action expressed, but only the first one will be able to seize this opportunity and the others will fall short. One thing that I didn't mention and that I can add for this to have a little bit more context is the way the transactions are ordered in the block is the way they will be considered. So each action will be considered by the way they're ordered. So if an action is last in the block, it will be considered last in terms of its implications. And it will be considered after considering all the other actions and their implications as well. Okay, so how's the winner decided? I guess a lot of people know, but. Money. Money. Right. So you can pay more, right? You can express a stronger preference in this network of nodes. But really, who decides the winner is whoever constructs the block, right? It is whoever decides the ordering of these transactions in a block. So whoever the predetermined leader is for that particular block, given a schedule. They can not only decide which action is going to be applied first, and so who is going to seize this arbitrage opportunity, they can also decide to seize it themselves, right? Because they have full control over the block. So I didn't mention the concept of mempool yet, but you might have noticed that in this abstraction, there is a moment between when the transaction is submitted and when it's included in a block. In that period of time, the transaction is pending, and it is kind of in a waiting room, if that makes sense, right? It's like waiting to be included. And the place where transactions are pending is the Ethereum mempool. It is really the waiting area of each node. So where transactions are waiting to be included. And so when a block is gossiped to the rest of the network, a node knows it can discard some transactions that have already been included, and it can keep the transactions that haven't been included yet. This mempool is public, which means anyone who runs a node is able to see the transactions that are waiting to be included. Okay, so far so good. I'll go a little faster. So we said who has the power here in terms of who would decide who the winner is, whoever construct the block. So in the past, this entity was a miner. And so hence the initial term to describe MEV was miner extractable value. Because it was a relatively simple, but at the time maybe less obvious realization that the miner and whoever constructs the block, in proof of work Ethereum in that case, has control over who gets this value. And ultimately, they can get this value themselves. So we can generalize ordering fees beyond just seizing a price imbalance between two liquidity venues. They have this early definition for what MEV was, which was not a formal definition. This is what I put below. So miner extracted value, now maximal, the total value that can be extracted from the reordering, insertion, or censorship of transactions within a given time frame, which may include multiple blocks, where for transactions, in our abstraction, we consider it a single block, because if you start adding multiple blocks, it's more complicated.
Just a question. I know this was a thought experiment, but I'm wondering whether there could be also like opportunities if you look at the mempool, not just at the previous block. When you place an order as an arbitrager,
Yes.
okay, you look at the previous block and then you identify whether or not there is an opportunity. For example, like get back plan a transaction which was included in the previous block. But I'm wondering like what percentage of transactions are actually arbitrage obtained by looking at the current mempool, and what percentage of transactions are based on the previous block.
So that's a great question, and actually, Quintus commented on this presentation before telling me I should mention this, and I didn't. So you're right that it's not only about seeing the latest state of the world in the block before, but also seeing the state of the world that could be from the actions that are submitted in this waiting room that is called the mempool. So what happened is that early on, the trading activity was looking at the next block. But as the market became more sophisticated, as these players entering these races with one another became more sophisticated, they pushed the boundaries to the mempool more, so to this waiting room area. So if it isn't clear for some people here, instead of waiting for the latest block and being able to understand the state of the world from it, you can also infer future states of the world by looking at the pending transactions and saying, oh, this hasn't happened yet, but it will happen. Let me already preemptively submit an action that will take into consideration that this will happen, right? So this happens because it is a competition that can only be won by a single player. It will always push the boundary of the competitive advantage that they can get. And so today, really, this has gone on for a little bit. Today, it's really mostly mempool, right? So it's mostly looking at the states that could be. And there's another reason for this, which is because of FlashBots, which I'll talk about. Anyway, all right, so you have an early definition. You have like a general concept. We've limited it to ordering fees in general, but maybe you have a stronger grasp of why this problem is relevant. Why whoever controls the block holds this power over how transactions are ordered, over who gets to win the arbitrage opportunity in our thought experiment, but also that the miner themselves or the block constructor can also choose to not include any potential winner and instead include their own action, seizing this opportunity. Good. So now we can talk about the MEV ecosystem. So what happened based on this definition and all of this, right? So before FlashBots, the way that people were participating in these competitions was going through this public waiting area that we talked about, the mempool, and they were bidding against each other. So these are graphs from a paper called FlashBots 2.0 from someone else from FlashBots. And you can see the orange. Nice. Whatever. You can see the orange triangle and the blue circle being two competitors bidding against each other. So iteratively bidding to get their transaction in for the same opportunity. You can see as well on the right side the fees that miners get and the fact that the ordering fees for particular blocks here in this case far overshadow the other fees that miners will get. So transaction fees and block reward. Give me 1 second.
Question?
Yes.
So just so I understand that graph, so that's all happening in between two block creations and they're just resubmitting transactions to the mempool with higher transaction fees?
Exactly. Exactly. So with the same nonce, but with a higher transaction fee. So there's a function of replaced by gas fee. So this is really a measurement that you can only measure in the mempool, not looking at the block content. So it's information that's lost once it gets in the block. So these are all resubmissions between two blocks.
Just another clarifying question, just so the mechanism is clear. Each of these transactions is bidding a certain amount
Yes.
in terms of transaction fees. How do you separate the ordering fees from the transaction fees? Because isn't it just one payment, like I'm going to pay this much?
Yes, it is one payment. But you can separate the two by looking at transaction fees that are paying purely for inclusion. And you can see the differential between the
So maybe the
gas
lowest fee that got in versus...
Yes, exactly. Any other questions?
You have time in milliseconds over there. Is that the speed at which people cancel and your first column?
Yeah.
Is that a reasonable time scale within which people submit and cancel orders?
Yes, so some of them will look at the activity in the mempool itself, and they will update their bids. Some of them will expect competition and will update their bids even without knowing what's happening in the mempool. Yeah. So you can see, for example, here the green and the red, the green thing and the green star and the red square is when the auction was actually decided. But the reality is that the people playing in this auction didn't know that the block was already constructed by then, so they kept on bidding. This is a property of proof of work because you have probabilistic block times, but proof of work is a thing of the past on Ethereum, so we can not dwell on this part. Right, so this paper, FlashBots 2.0, evidenced a few things related to these behaviors. The first one is that this iterative bidding behavior was causing a lot of issues for other users because it would increase their own transaction fees because the transaction fees were socialized to everyone in the network. And so it would make the network more expensive to use for other users. Users that had very different needs for what they wanted to use the chain for. The other thing that was worrying is really this graph on the right. And so it was the idea that the financial incentive related to ordering fees was growing larger and larger. And these are particular blocks that are selected. This is like the highest observed pure revenue, but this was from 2019. Yeah?
It's a good question on the graph. So I see actually the auction winner was actually selected quite early, right?
Yeah.
5 seconds. But they keep bidding with each other until like 12 seconds.
Yes.
What actually might be the reason because of network latency?
Yeah, exactly. They don't know that the block has been closed shut already, and it hasn't been gossiped to the network yet.
Right, but if the latency is really large, how can they actually be with each other within a very short time period before the window is selected?
Yes?
At the runs of the bidding, it's very close, right?
Mhm.
So it's really due to the latency network that they really can't see each other's message instantly. How can the competition actually then?
Yeah, so some bid expecting competition, so they bid more of a time, which is a little weird now that I think about it. The other thing is the latency of peer-to-peer network is not that high. So like a message is propagated throughout a peer-to-peer network depending, of course there's like edge cases, but usually like 100 to 300 milliseconds, maybe less. So you can see, if you're observing the mempool, you can see this stuff and you can react to it. There's also, this is a one-shot game that we're looking at here, and I think the reason why some people might bid preemptively is because they have data from many one-shot games, and so in the iterated game, they know that they have a particular competitor that will bid against them, and so they're happy to play this. Why don't they max bid immediately? Well, then they would bid all the opportunity away to the miner, so they would rather play an iterative game. Anyway, moving on, this is less of the thing I would like to focus on. One big issue that was mentioned in this paper was the fact that there was a growing incentive for miners to stop building on each other's blocks, but instead rebuild the same block in order to capture the ordering fees because they're so high for some particular blocks. And so there was this kind of risk that is mentioned in the paper, and this is an extract from the abstract, talking about security risk to consensus layer security risk, so causing consensus layer instability, and a potential risk to Ethereum itself. So if miners are not incentivized in proof of work to build on top of each other's blocks, the chain stops advancing because they're trying to replay who mines this particular block that holds, for example, $10 million worth of value. And so while this risk wasn't happening in practice, what the paper was saying was, hey, this incentive is going to grow more over time as Ethereum is used more. And this might be a problem in the future that is existential to Ethereum itself. So there are other risks related to this activity. The increased fees is one that I mentioned. The state bloat and increased network load. So they're basically spamming the Ethereum mempool, which is fine, but it's just unnecessary computing load that's put on each nodes that are like watching this mempool, which is okay, but if it can be avoided, it's better. And also, the winners are included on chain, but also the losers are also included. And so there's a lot of useless transactions that are included on chain from the perspective of they didn't need to be necessarily. And so it's wasted block space, wasted storage space. The other risk that was worrying is that as this incentive grows, not only is there an incentive for these type of behaviors to happen, but there's also an incentive for miners to become traders, right? Where what I mentioned before, instead of just accepting users' trades or these traders' trades, they could just say, well, no, I'm going to become a trader and just like put my trades, prioritize my trades in front of everyone and make money. And this was particularly worrying because it points to a vertical integration within the stack or the transaction supply chain stack that causes like increased centralization in the system. So FlashBots came in. This is an extract from the blog post. I should have introduced FlashBots at the beginning of this talk. Sorry. We started as a research group, an R&D group, to mitigate a lot of these issues that are talked about here. And so we saw this problem. The writer of this paper is also a member of FlashBots, and we're like, okay, what can we do about it? And we had these three-pronged approach to it. Yes. So three-pronged approach, you can see at the bottom. Illuminate, democratize, distribute. I'm going to talk about it briefly. The idea was we wanted everyone to have access to these fees, so all miners to have equal access to the fees that they could make from it. We wanted to make sure that this problem that we saw was less opaque than it would be otherwise. and so providing data, providing research for this, and distribute benefits, meaning there's a lot of value in this game, and we want to make sure that it aligns the stakeholders of the system in a way that's beneficial for everyone. So how we did this democratize is we released this open source miner software called MEV Geth that created, I know it's controversial, created some auction between traders and miners. That was an off-chain auction on a separate lane from the submitting your transaction through this network, this public mempool. This in turn avoided miners cutting unilateral deals with traders, and there's a vertical integration risk because now they could just listen to this auction and get people cutting deals with them on a per block basis, which was the purpose of the system. It's not perfect, but it was a first step. The other thing we did related to Illuminate is we released public dashboards that quantified MEV, organized a lot of events, started publishing research, et cetera. We don't have to go into this again. This is more to give you like a picture of like how we went from what the system was to FlashBots coming in. And so what happened after we released this was like December 29th, 2020, and the blog post was November 23rd, 2020. This software was adopted very quickly by the Ethereum network. It went from January 3% of the hash rate to April 84% of the hash rate. Hash rate being the amount of Ethereum miners that are running the software. And on the right, this is data from our own open source repo that you can use, charting cumulative gross profit of miner extractable value through time. And you can see kind of a sharp rise, but also just the absolute number itself. That is, this is a lower bound, but 660 million and probably closer to a billion or so. And this is not today. This is, again, representative. Yes?
I was going to ask if there's a kind of incentive for the miners to just download the software and use.
Is there an incentive?
Yeah, for miners.
What do you mean?
So I understand that 84% of the miners are using it. So
Yes.
so there's the MEV over there, and they're just stop just capitalizing on this MEV and using FlashBots software.
Mm-hmm.
So what is the incentive behind this?
Okay, so the way the software was structured is a very small patch on top of existing miner software. That's called Geth, which is the Go Ethereum instance of an Ethereum client. Ethereum client being the software run by each node of this network. And so what the software did was constructing a block the usual way, or a vanilla block, and constructing a block that would be partly vanilla and partly considering this additional lane where transactions are sent through. And then it would profit switch between these two blocks on the one that was giving the maximal value. So from the perspective of a miner, this is strictly additive, at least in a one-shot game. They can either construct a block they would normally do, or they can construct a block that's better. So the incentive is there, in that like there's an opportunity cost of integrating the software and assuming some of the technical risk of running software that's experimental, but this is why we limited it to a very small patch on top of existing software and one that is relatively self-contained in the parts of the code base that it touches. And then the structure itself means that we can credibly say you'll make at least as much money for the blocks that you build. Please.
Right? Yeah. So I'm trying to understand, so the maximal extractable value has gone up.
So this is extracted, not extractable.
The extracted value, right? The realized
Yes.
value. So I'm one now because I'm thinking like a couple of forces now here. And on the one hand, I can see that because of FlashBots, all the users who are worried about like submitting their transactions through the regular channel to avoid front running would decide to go on the FlashBots, and as a result, the miners will.
Yeah. So the way you're talking about FlashBots, you're talking about FlashBots Protect, the tool that users can use to avoid going through the Ethereum mempool, and to have this behavior that we talked about earlier on after your question, right? Of like someone seeing a user intent and being able to react to it in a way that that may be taking advantage of the user. However, the growth of this graph is really related to the rise of DeFi. So decentralized finance really grew starting June 2020 after the token distribution of Compound. So Compound was one of the first to do a token distribution that's gradual, starting the craze of like yield farming in general. There were a few before, but Compound was really the one that gathered a lot of attention and attracted a lot of liquidity into these DeFi venues that until then were quite thin compared to their counterparts. And so as more liquidity flowed in to decentralized finance, a lot of these opportunities related to ordering became much more valuable basically as a function of like total value that is in these systems and that is able to be seized. A lot of this liquidity was from unsophisticated users as well, and so those were like additional inefficiencies from retail and the fact that they don't necessarily care a lot about execution. At least they're not as sophisticated about it as professional traders. All right.
The benefit that we're getting is from the ordering.
Yes.
So is that not just the sort of cumulative winning bids in the auctions, or is there actually some transaction inspection to compute that graph?
This is transaction inspection. So MEV inspect pi runs an archive node and goes through transaction traces, and then we run specific logic for different types of opportunities, and then we categorize them. So this is not FlashBot specific. This is just running this code base on historical Ethereum data, and in particular on transaction traces, not on event logs. At least doing a mix of both. So yeah, it's per transaction. This is why it's a lower bound as well, because we had to skim a lot of value that could be false positives, because we wanted to just start with something that we're very comfortable with. But it is somewhat heuristics based. And there's also the question of how you quantify value. This is in US dollars, but some of the value secured might be secured in ETH, and so you need to register a price of ETH, and then you get in a lot of complexity there. Oh, time. Sorry. I'll move on quickly. Right. So the MEV industry grew. At the same time, the academic field grew. It's a mix of a lot of really cool fields that were already mixed before, but this was an interesting meeting place for all these fields together. At the same time, at academic conferences, more and more papers were talking about MEV, talking about the negative externalities of MEV, talking about all the issues with it, talking about all the opportunities with it. Anecdotally as well, I put DevCon talks. DevCon is an Ethereum conference, the flagship conference. This year, it had 18 talks on this topic, and at the last event, which was 3 years ago, there were 0 talks on it. And so, as Shamak mentioned at the beginning, when introducing us, this has become a hot topic. Also because more and more, the more you dig into it, the more you realize how it permeates a lot of these systems. So why care? I didn't do necessarily an excellent job at explaining so far why I care. But I think maybe you got a sense of the fact that this is like a very rapidly growing industry, where there's also a lot of interesting research to do. And it has many characteristics of a nascent field, right? So engineering is currently driving theory rather than the opposite. The taxonomy is relatively unclear, and so there's a lot of people trying to redefine terms, and this is another sign of like a new industry, is when you get to define the terms, and a lot of people are trying to impose standards. And it's very weakly formalized, so there's a lot more formalizations needed in many places. But currently, formalizations are just starting, and it's still unclear what are formalizations that make the most sense. By this, I mean that they're useful and that other people understand them. Another reason to care is that it's a high-impact industry, and so this problem that we talked about here is like quite fundamental to how these systems work and how you might order sets of transactions together. And it underpins a lot of the fundamental infrastructure that is built upon and that applications are built upon. So even if you are interested in like application level things, say you're interested in issuing NFTs and that type of stuff, MEV will show up one way or another in how you design your system and in how users will experience it. Finally, what I mentioned, MEV, we believe MEV is fundamental to permissionless systems. And we want to make sure, one, that it doesn't destroy these systems, but also that we can harness it. In a way, a lot of what MEV is a lot of the ways to understand MEV is looking at the activity of economically rational actors and where the incentives lie. And so it's important for any permissionless systems, especially ones that have value in them, to really think through these things well. And we think that without really studying this problem deeply and harnessing MEV, it would be very hard to build this technology, or like the promise of Ethereum, which I've summed up as like a trustless, scalable economic coordination layer or technology, or generally a technology for trustless human coordination. So how do we get there is maybe this is where you come in and help look at the problems that are still there, look at all the ways that we can improve this to get to this like brighter future for what Ethereum and Ethereum-like technologies want to be. So this is not necessarily constrained to Ethereum only. Passing it on to Quintus. Sorry, I think I rambled a little bit. Oh, yes.
Can people hear me? Is this working? Yeah, excellent. Okay, we want to leave some time at the end for questions. So instead of like a well thought out, slow talk to make sure everyone understands, I'm going to speed run through some exciting things and try to get everyone either excited or a little bit confused, but that means you have more questions. That's great. So what are the open problems that we're curious about? There are many. And so I'll try and narrow them down and think about a user's perspective. A lot of what Alex was talking about in the talk before, and what FlashBots has been doing, is taking a lot of mitigating the negative externalities of MEV, but also if you think about traditional finance, we're capturing a lot of the value that would have gone to like low latency infrastructure providers in HFT races and internalizing that to like the blockchain system. So that's interesting. But I'd like to think about things from the user's perspective today. Like Alex mentioned earlier, a lot of MEV opportunities actually depend on user transactions and actually affect user transactions. What the mempool looks like today is something more like this, right? Searchers are watching the mempool, waiting for a user to do something and to pounce on that. And there are many ways of mitigating this. Maybe something vaguely analogous is in traditional finance. What ends up happening is you have this paid-for order flow structure where retail order flow is separated away from like toxic HFT order flow, and supposedly this is better for users, although it's somewhat controversial, but I won't dive into that. It's just something interesting to keep in mind. So one of the suggestions that have come up and that we've looked into, or I've looked into relatively extensively compared to everyone else, I guess, in blockchain, order flow auctions. So a lot of these MEV opportunities depend on user transactions, like I was saying earlier. So one idea is for the user to go and say, hey, like, this is my transaction. I will. There are many instantiations, but the vanilla instantiation would be, I will give the right to execute my transaction to whoever bids the highest to me in the next 2 seconds, 5 seconds, whatever. And in doing so, even though the user might receive worse execution, and I'll get to that in a second, the user can capture some of this MEV value that they're sort of like letting out into the world. It's much more complicated than just running an auction for a variety of reasons I won't get into. But I think I've been making this claim that extracting MEV is sometimes bad for the user, and I haven't completely explained why. The rough idea is that you've seen that these blocks are being produced with multiple transactions in them. If you're one of these transactions as a user, you don't actually know if you're going to be executing against the state that was Ethereum state at the last block, or what maybe the price of the DEX you're trading against has changed in the transactions above you in the block. So what usually happens is that these transactions are considered valid within a range. If any of the following prices are fine. But you can imagine if you're someone executing this transaction, you can say, okay, well, this is the market price. This is what the worst price they're willing to accept. I'll execute here and take the spread. That's like the rough idea, right? And so it's generally often not very good for users. And order flow auctions try to mitigate this. One of the issues with order flow auctions is that it's not clear how to do them in a decentralized way. Like the sort of the key value proposition of blockchain is this sort of nebulous concept of decentralization, and many people have tried to define it. The definition isn't important today, right now, but I'd like to get to the point that a centralized auction is a problem. If the only way that users can get decent execution on a blockchain is by routing their orders through a centralized actor, in some sense we failed in our mission. So how do we make this decentralized? A second interesting aspect of order flow auctions is that unlike frequent batch auctions that were proposed in traditional finance, we would like to support like, general order types, right? In traditional finance, we think of like market orders, limit orders. That's kind of like the spread, and there may be some other orders. But in blockchain, really, it's like anything you can imagine. It doesn't even need to be a DeFi order. It can just be a transaction of some other kind. And I should say that people extract MEV from like on-chain games, you know, and NFTs. It's not just specific to like trades, for example. And that's super exciting. I think it's very general, especially when these different kinds of MEV interact. And then another thing we have to take into account is that Ethereum already has its extant fee structure and all these different components to it. And so how does the order flow auction interface with these different components? What does it break, or what does it have to work around? Another interesting, please just put up your hand if you have any questions, but I'll try to run through this quickly so we have lots of time at the end. So let's imagine a world after we have instantiated the order flow auction. We still have this weird dynamic where even though a user internalizes a lot of the value that they're sort of like is being taken from them by having bad execution, it's still the case that what we call searchers, this like sophisticated party, this trader, whoever has bid for this transaction, is incentivized to execute them often in the worst possible way, because this will maximize the profits of the person who's executing their order. What if we can change the incentives so that this ecosystem of highly sophisticated actors that we've been building, who have much more information than the users and are generally have much more sophisticated software, are actually, they have their incentives aligned with the users. And so instead of trying to extract value from them, or rather extract value from them by giving them bad execution, extracting value also means giving them better execution. Right? How do we do this? Maybe you can think of some ways of doing it for the like specific, for a specific order type. But how would we do this? I messed up the order of points. How do we do this for general order types, right? If we want to allow users to submit any kind of transaction to the network, how do we allow them to sort of express their preference over execution? Another point which is up there is that this is also complicated for users. Right? The more we expect users to act in a sophisticated way to set incentives for their transactions, the harder it becomes to use. And really, like we all agree that it should be as easy as possible to interact with blockchains if we want a lot of adoption. And just to speed run another interesting area of research is privacy. Right? We can all understand already, having seen the mempool explanations, that exposing your order to a large number of people really often is not to your advantage, right? Because people can see what you're buying, when you're buying, perhaps even how much you're willing to pay to bribe people to execute your order, they can trade against you, they can do all sorts of things. So how do we enforce privacy? Right now, how do we enforce privacy while still preserving the properties of the underlying system? Maybe you can encrypt all the transactions until they form in a block and then decrypt them, but then how do you tell spam from not spam, right? These kinds of things are important problems. But also, like if we're in this world that I was describing earlier, where you have these highly sophisticated agents that execute your transactions for you, if you harness this MEV, how do you allow people to execute your preferences for to put it as generally as possible, while not knowing what you're trying to do? Right? What is this balance, this efficiency privacy trade-off? Maybe I've lost some of you there, but I'm sure some questions will come up. And then let me just finish, and I'll take some questions. And then lastly, what are the new applications that arise? If we're able to harness this MEV ecosystem to incentivize users, or to incentivize these sophisticated actors to do complicated computations on the behalf of users and aggregate lots of information that they see from the mempool and from the outside world, maybe keeping track of prices on sexes and these kind of things. If we have this force we've harnessed, what can we do with it? What are the computationally heavy tasks, perhaps, that we can't do on blockchains today that we can maybe outsource to this ecosystem? And so I guess what I want to say to summarize everything I've said is that MEV is often very useful. It makes prices efficient. you can rely on liquidations happening, these kinds of things. But often, often it's at the detriment of the users. And there are many ways to try to change this dynamic and perhaps even flip it to the betterment of users. There's a lot of opportunity out there for both research and starting companies or whatever. So I challenge you to get involved. And I think that's everything. Yeah.
Go ahead.
Yes. Okay, we'll take questions now, I think. Yeah.
So your comment about privacy.
Yes.
Is privacy for you the fact that I'm showing my bid and what I'm willing to pay? Is that, or am I showing my name?
Yes. Okay, so there's many different ways of thinking about privacy. I think you can put those all on sort of on the same spectrum where on the far extreme to one side, you're exposing everything.
What did you mean?
I meant this complete spectrum where I think like maybe your name isn't exactly what I mean. Like I'm not talking about KYC, but something analogous would be like exposing your public address. If your public address is exposed, someone can link that back to your trade history. And then in the more traditional finance sense of the word, people can tell, are you toxic flow or are you non-toxic flow, right? So maybe you want to obfuscate that, maybe you don't want to. So that's an example of where privacy plays into this, but other basic examples like what exchange am I trading against, how much am I buying, how much am I selling? You can think of it in a more computational sense which is possible through various cryptographic means where instead of revealing information about your order, you let someone simulate the conditions of your order executing and then let them see something about that execution. Like for example, if my blinded transaction is executed ahead of this searcher's transaction, which is simulating, how much does the searcher get paid? I'm not saying that's necessarily a great idea, but that's something you could do.
Basic information like what I'm bidding, what I'm willing to pay, my quantity or things like that. It's just the defining characteristic of the limit exchange.
Characteristic of what?
Of a limit order book.
Yes.
I can see the orders. I'm not seeing who's trading, but I can see the order book, and then I can actually place bids and offers and do whatever I want. So in financial markets, that would be considered, you're anonymous in that market.
Yes.
We're just seeing market data. Right, so, but order flow is private at that point in time. You cannot decipher whether it's me sending these bids and these offers in one exchange and the other. You can only see an order going.
Yes. So,
are you saying that I have an identity so that you'll be able to tell that I'm trading on that exchange and on another exchange and link these orders back to the trader?
that's less of what I mean. I think you can introduce that into the conversation. But when I talk about privacy, I'm talking more about the details of what you're trying to execute. And the reason that you can obfuscate this, at least at some part of the sort of supply chain that gets your transaction onto the blockchain, is that not every entity necessarily needs to know everything about your order in order to be able to execute it. Obviously, at some point, your order has to be available in plain text to do things like verify that everything has been executed according to the rules of the system and these kinds of things.
Maybe an analogy there is you're sort of providing privacy before the order hits the matching engine, right? In traditional markets, that's not a problem. Nobody sees your order before it gets to the exchange.
I agree that's a good analogy, but I think you can push it even further and say even in the matching engine, you could have some sort of privacy without going into like cryptographic details. You could simulate not knowing exactly what the contents of a block is, but try ordering these like obfuscated packets of information and just know, oh, it was correctly executed or was not. The block is valid or was not. And so even at the matching engine level, or I guess if you consider the matching engine level to be the smart contracts, then no. But even at the block building level, you could obfuscate it. But perhaps that's getting a bit too much into the weeds. Yeah.
Other questions? Yeah.
There's this critique in the industry of your product, that your solution, that it's currently censoring OFAC sanctioned transactions, like for Tornado Cash. Can you comment on that?
Sure. Do you want to specify your question more?
So that is arguably a force of centralization in Ethereum. That if we had when we had independent validators or miners constructing their own blocks, and they could independently decide if they want to follow OFAC sanctions or not. when some majority of them are just using the MEV Boost product, then it's your organization that's determining the censorship, so it becomes a lot more prevalent.
Yeah, so for the people, I'm not going to explain MEV Boost, but for the people that know more about this, I'll give an answer. You're pointing out the fact that we're centralized, and so that we're subject to certain regulations, right? Which is, we don't have to go into the legal analysis of whether we should or not be subject to these regulations. And that's like, yeah, you should check that as well. But at least what this problem points to is really the fact that we're running like centralized infrastructure. And what we're trying to get towards as an industry is really that this doesn't run on centralized infrastructure. And so what this behavior that FlashBots has been doing evidences is the fact that we're running centralized infrastructure, which we always were. Now you wanted me to comment on it. So I think in proof of work, FlashBots was involved in a lot of blocks. Difference is that we were producing partial blocks. So we were producing a subset of a block and then shipping that out to the miner or all the miners, and they were able to add whatever they wanted at the end of it. Now that we move to proof of stake and with a separation between who validates the block and who builds it, now you have a market of people who build full blocks. And so they impose their regulatory constraints on the full block. Whereas before, when partial blocks were constructed, you were able to do what you mentioned, right? Where like miners had some power. I'd argue that like were FlashBots to like do nothing or not be here in proof of stake, the situation would likely be worse. Because MEV is extremely centralizing to the validator set. And so it's likely that they would be an even more powerful player, a more entrenched player, in a way where I think regulation is inescapable if there's centralization. I don't know if that answers the comment or the question, or if you want more.
It sounds like there's a roadmap to try to move away from being as much of a centralizing force.
Yeah, I think if FlashBots stays centralized, it dies. It's very clear. Or it's just a very different value proposition. Other questions? At any level of the presentation as well. So it can be like much more. Please.
Can MEV be eliminated? And if it can, would it be just better for users?
So you can have a system without MEV. I think if you do, I think the system is not useful. In a way, a lot of what MEV is like kind of inefficiencies that surface in the system and surfaces in places where value is created. So I think it is inherent to the systems. I think a lot of the discourse has been very much black or white about MEV mitigation, or let's try to capture as much value as possible from MEV. And I think there's a wide spectrum from sources of MEV, so where they're created, and then looking at different stakeholders in the system and like the experience. That being said, like users getting worse prices because of like predatory behaviors of other actors in the system is clearly bad. And it would clearly be better if that wasn't the case. But it doesn't mean that all sources of MEV are necessarily bad. I don't know if you have a comment, Quintus. If not, I can keep going.
Yeah, we're at time. I think the only real comment is if you have two people who want the same thing, and there's a third entity that decides who wants it, it seems like you have MEV. If there's a way for them to pay for it, but if the thing they want clashes, right? Like if both of us want one NFT, but only the first one gets it, and there's someone who controls who's first. Relatively basic idea, I think.
Please.
So I have a question. So a lot of what you suggested sort of seems to be about blurring the sort of consensus layer with the application layer. For example, the idea of order flow auctions. If I sort of squint my eyes, that really sounds like setting up some kind of limit order book or RFQ system, but doing it like at the consensus layer, not at the sort of the smart contract layer. if you flip that, I mean, another direction to go would be to try and handle MEV at the application layer. Like maybe you want to deal with MEV differently if it's like sandwiching versus if it's arbitraging or or whatever. So I'm kind of wondering, is there like a philosophical spectrum here in terms of where to handle it, or is it really sounds like this approach is really centered around handling it at the consensus layer?
Yeah, I think there's, without having concrete proposals, but I'm aware of some like rough directions, there probably is room for applications to improve in sort of protecting users or internalizing MEV and these kind of things. But at the same time, I think there's a sort of a limited information that applications have access to. But an application doesn't know how many orders or which orders have been submitted to the validator. It can only really interact with those that have been included in the block. And I think there are other examples of information which only exists outside of the application layer, or at least in the current instantiation of blockchain. And so I think in that sense, applications are limited in what they can do in the MEV landscape.
Could you comment on how a block builder could be designed in a more decentralized way?
There's Vitalik gave a talk on this at SBC. If you Google decentralized, or if you go on YouTube and look up decentralized block building, MEV workshop SBC or something, it'll definitely come up. Alex, I don't know if you wanna talk about decentralized block building, or
I think there are different approaches. On one end of the spectrum is like bringing it as a way for nodes to come to consensus on the order of transactions. So there's this trend of like ordering protocols that are trying to do something along that line. In that case, you get to a block without a single entity having control over the ordering. And so you could argue that's distributed block building or decentralized block building. There's a lot of trade-offs with these ordering protocols and that approach. Yeah. So one avenue is ordering protocols. Another avenue is potentially looking at this supply chain from the transaction supply chain, from where the transactions are submitted to when they land on chain, and think of at every layer, at every interface between different players, how you can maximize competition in a way that is also contestable for other players to enter. And potentially, if you have these markets at these different layers, you could argue this is like another way that a blocking is constructed where you don't have like central parties that are, or like a single parties that are involved at different parts of these interfaces. That's a kind of slightly different approach that is maybe less rigorous in like decentralized block building, but that might achieve a lot of the properties that we would like to have. Yeah, I recommend the talk at the workshop that we organized in
SBC.
Yeah, SBC in August.
To follow up on the issue of the transaction supply chain, how do you think about the balance of value between, let's say, user or originator, searcher, builder, and validator, both in terms of like where it is and where it should be? And does Suave play into that?
Yeah, great. That's a great question. I think ultimately you can simplify the supply chain to two sides, the users and the validators or the miners. So on one side, you have the block space suppliers, and on the other side, you have the block space consumers. I think everyone else in the middle, searchers, traders, builders, etc., I think we're subject to these market forces. And ultimately, I think the value and the bargaining power is really between these two kind of sides of the market. I think there are many suboptimal equilibrium where people in the middle of this supply chain gain a lot of bargaining power. I think that would be suboptimal. In that ultimately I think the bargaining power should be held between the users and the validators, and the people in the middle are facilitators of this market in a way. And this is a lot of what we focused on at FlashBots was on the validator side or the miner side of things, using searchers to maximize the value of the miner's block space. And a lot of what we're going to do in the near future is focusing on the other side of that market. So making sure the users are more aware than they've been in the past of their bargaining power, and giving them the tools to express more granularity on their bargaining power. And you mentioned Suave, right? So that's something we announced recently at the Ethereum Developer Conference. It's, I guess, the next iteration of the infrastructure we're building. And in a way, when you think of the block space supplier and the market, that side of the market, and the block space consumers, that other side of the market, the ambition for Suave is to be like that marketplace in the middle that is able to serve the needs of both sides. So in a way, it's just continuing what we've done so far. Can share more about it, but it will get very deep, unnecessarily deep. We're also at time. That's why.
So just in the interest of time, let's take any further questions offline and let's thank the speakers.